Hello, and welcome to today's episode of the Macrocast. I'm your host, Ylan, a managing director at Penta. My co-hosts are John Fagan and Brendan Walsh of Markets Policy Partners. How you guys doing?
Very good. Busy week.
Very busy week.
Yeah.
In fact, there is so much economic news that's come out that it's almost hard to decide where to start the conversation. But of course, all roads lead to the Fed, so we have to begin there. As expected, the central bank left its benchmark interest rate unchanged at 5.25% to 5.5% during its most recent meeting. Not so expected was the fact that Fed officials are now forecasting as many as 3 rate cuts next year. So looks like the Fed finally caught up to the markets, guys.
The market has been leaning into the rate cut expectations, even as the Fed has clung to this higher for longer and some rhetorical pushback on this that we saw going into the meeting before, even, kind of just before the blackout period. It sure sounded like, they were trying to talk the markets out of these increasingly aggressive and early rate cut expectations that had been reflected, over the past basically over November. And so, there was a lot of kind of questioning going into this meeting whether the Fed would try to really push harder back on these expectations, and quite the opposite occurred.
One thing that was kind of interesting is we got the CPI report before the Fed came out, and that was very much in line. But then we also got the PPI report, and the Fed does not use they look at the CPI, but they use the PCE price index, and really all it is it's the same measurements, but they weight them differently, and they use a lot from the PPI. So once you have those two measurements, you can put it in an Excel spreadsheet and figure out what it is. It's not rocket science. So they basically kind of knew, and core PCE on a month-over-month basis in November is coming out at 0.05. So the month-over-month for core is either going to be 0 or 0.1, which is very, very low. So that might have been one of the factors that gave them a little motivation to start talking about rate cuts in 2024.
Yeah, I feel like we have to revise the phrase higher for longer to higher for not so long, or higher for not that long. Because it was really surprising to me that, even just as recently as the previous Fed press conference, Chair Powell was pushing back on the idea of rate cuts. Here's what he said during the press conference in November.
The fact is, the committee is not thinking about rate cuts right now at all. We're not talking about rate cuts.
So Powell was saying that rate cuts were not even entertained as part of the discussion. But since then, obviously, rate cuts have entered the chat. And here was Powell at this week's press conference.
The question of when will it become appropriate to begin dialing back the amount of policy restraint in place, that begins to come into view. And is clearly a topic of discussion out in the world, and also a discussion for us at our meeting today.
So, guys, we've been talking about this idea of when the Fed is going to pivot, but this really does feel like a whiplash. I mean, he said one thing in November and is saying basically the opposite in December, and it's hard to imagine. I mean, we know that the data has come in the Fed's favor, but has it really been that dramatically different from what they were expecting?
Not really. And certainly, I think Brendan made a very good point on inflation. Inflation's going in the right direction, but, it's not at their target. And to be fair, Chair Powell said all of this. He said that inflation is not where they want it to be, and they still got work to do. And he sort of mouthed all those things that remain true. But certainly, when you look at the incoming economic data, it hasn't exactly been falling off a cliff. We've had some softening in the labor market data, and but most of the indications have come in slower than a very strong third quarter, but far from weak or recessionary.
One thing that I keep kind of going back to is in terms of its kind of surprising timing of this is the fact that next year is an election year, and the Fed doesn't want to be political. But I think if they looked at their 2024 outlook and they saw that things aren't going to get quite as bad as they thought, but also inflation is coming off as fast as they thought. So in that view, they thought, well, maybe in the second half of the year, we could do some rate cuts. But if you waited 6 months and then for the first time brought it up in the summer, you're only a couple months from the election, and then that could be seen as favoring one candidate or the other. So maybe they decided this is really what we believe we're going to do, but now's the time to tell the public about it. So in 6 months, you'll forget that we did it, and it won't become a political issue.
Yeah, they can start seeding the idea now. In reporting, we call that floating the balloon, right? And seeing how the markets react. Because certainly, if they were to start a series of rate cuts in the second half of next year, I mean, the timing would just be seen as political. I know the Fed, is independent, and they are very stridently apartisan, not even nonpartisan, really, apartisan. But it'd be hard to separate the two, especially in an environment where you would have likely the Republican nominee, former President Trump, not afraid to be vocal about what he wants the Fed to do, and I think some of the other Republican candidates have also expressed a lot of interest in seeing the economy get stronger.
Right, and President Biden's polling numbers are not great, and a lot of it is people aren't happy with the economy. So that could be seen as a way that the Fed was trying to help Biden.
Yeah, and so that makes it even more sort of mysterious to me why we've gotten this pushback from the New York Fed president, John Williams, after the Fed press conference and the Fed decision, saying that a March rate cut or a discussion of a March rate cut is premature, and that even they didn't talk about rate cuts during the meeting, which seems in exact opposition to what Powell said and how he described the tone of those conversations. So I'm wondering if the Fed felt like the market reaction was maybe a little too exuberant, worried that investors are now sort of getting over their skis and trying to walk back some of the excitement around the possibility that, we could see interest rates start to fall.
Yeah, well, John, the market had 5 priced in for next year, and then the Fed said we're going to do 3, so then the market priced in 7.
Yeah. I mean, the market is now like pushing the Fed around, and I think that there's it really is, there's no reason that, you would go into this meeting thinking that a talk about rate cuts, and a dot plot that increases the number of rate cuts that is in the median for next year isn't going to do anything but get the market even more excited. I mean, we've been pricing in increasingly aggressive easing next year for 6 weeks, and the market has, everybody knows, and the Fed officials know this just as well as anybody. The market gets a bit in its teeth and runs and will overshoot a trend, pretty much every time. And so if John Williams has been purposefully kind of sent out here to talk back the market expectations, that suggests that they kind of, fumbled the communications. I don't see how they could have thought that, telling the markets, admitting, yes, we're discussing rate cuts, and then upping the number of rate cuts into the median dots. I don't know how they didn't think that would get the markets like really frothy and excited. But maybe they didn't.
Yeah, it was an interview on CNBC.
Yeah, it was.
So do those just pop up? Like, do you think he was on the schedule a week ago, or did you think he called yesterday and said, I need to get on?
Well, he's in blackout on Thursday, so hopefully he didn't call. And
yeah. But maybe
they schedule these in advance. Who's going to go out and
that's
speak,
what I figured.
et cetera. Exactly right. No, but I feel like the other sort of confusing factor is if you don't cut rates in the first half of the year, right, but you do 3 in the second half, that also sort of suggests that has something fallen off a cliff, right? That you would need to move that quickly, 3 rate cuts in 6 months, right? So I don't think that's also the message that the Fed wants to send, which is that we're going to be in such a dramatic slowdown that the Fed would need to act that quickly and aggressively. I think what they would like to communicate and would like to see is this trend that we've been experiencing so far of the gradual slowing, the gradual softening, and the Fed can sort of ease into a rate cutting cycle rather than have to act so aggressively.
Right. Because they also put in 4 for 2025.
Well, I got to say, my CD is maturing at the end of this year, and I'm not going to roll it back over. I feel like I hit that just right.
Yeah.
So let's talk a little bit about some of the data that the Fed is looking at. You talked a little bit about CPI and sort of the PPI numbers, Brendan, but we also got retail sales over the course of this past week, and the consumer is still looking like it's pretty strong.
Yeah, the numbers came in positive 0.3%, where the kind of consensus expectations was for 0. And I think a lot of that commentary was from companies reporting, like Tyco laid off 20% of their workforce. But I think we're in a somewhat confusing times for macroeconomics, because I think we're just seeing consumer behaviors changing. The pandemic certainly changed things, where people bought things for their house, and now you have enough things and toys and things like that. So I think it's there's a lot of noise out there to try to figure out, is the consumer really in a rough place, or is the consumer just spending money on other things, or they have enough of certain big ticket items. But from the government data, it kind of seems like the latter, that the consumer is still doing fine, and the jobs numbers are supporting that. Last week, unemployment claims unexpectedly dropped, where they had been inching back up. So they're now at, you don't want to get too caught up in week to week, but they're back to where they're kind of the lows were. So there's no really indication that the labor market is really, really weakening. When people have a job, you still have the same amount of money to spend, right?
Would slowing inflation support a stronger retail sales number? Or would that result in a lower retail sales number because prices are
so it's not they don't adjust for the it's just the nominal numbers, so they don't take out the inflation. So yes, lower if prices came down and you spent less on a sweater, that is just registered as spending less on a sweater. Yeah.
So the fact that retail sales increase even as prices are slowing, so people have more purchasing power, and so it means they're buying more, they're spending more, and getting more for their money as they do it.
Yep.
Yeah, that's fascinating.
That's a really important point. Yeah.
Yeah, I feel like looking at some of the holiday retail traffic numbers, I think it was something like 200 million shoppers either went out or spent money online during Black Friday. So there's appetite certainly, and there's demand. Maybe the question is more around channel and category of spend rather than are consumers willing to pull out their wallets at all.
Exactly.
Yeah, that interplay between growth and inflation, I think it's a really good point. To the extent that markets are priced for perfection, really what they're pricing in is not just a soft landing, but like an immaculate levitation, right? Where inflation comes down and growth never really slows. And we talked about, you can't have a soft landing without softening. Maybe the economy doesn't soften that much at all. You get inflation coming down. You get the Fed cutting rates, not because they have to, but because they want to, because they can, because inflation is just so much cooler than it was. And that really is, the most bullish and, fantastically pleasant scenario for risk assets and the economy next year. And, increasingly, that's what it looks like the markets are priced for. If you want to try to make the Treasury market like Fed fund futures with like 7 rate cuts priced in next year, that's usually a recession, right? You're not slashing rates by, 150 175 basis points unless you're facing a very, dismal economic growth outcome. That's typically the way it works. But, look at credit markets, look at equities. These are not priced for anything like a hard landing, a recession, or even, much of a slowdown. So, that is the bullish case, which is, the Fed is just, they're just keeping up with the rapidly falling inflation, and it's sort of the revenge of Team Transitory. We already had Larry Summers come out and say, Team Transitory, they may think that they've got it back, but they were wrong. And
that's a clear sign that they've won.
Yeah. And the other thing to keep in mind about the inflation numbers is these are still including high housing data that is working with a huge lag. So that has yet to flow through into the official numbers, which is going to drag these numbers down even more.
Yeah, I felt like at the press conference when I was reading through the transcript and listening to it in real time, I was sort of surprised by the number of questions around, is this a sign that the Fed is bracing for a recession? Because to your point, John, it felt more to me like, this is the Fed sort of letting off the brake and maybe an acknowledgement that this idea of holding steady is actually tightening.
Yeah,
right?
yeah.
That holding rates where they were at because of where inflation is going, because of the strength in the job market, et cetera, it's actually restraining activity if they just did nothing.
And they're still continuing quantitative tightening, so they're letting their huge balance sheet run off. There's no plans to change that.
Yeah, has the Fed and hopefully I'm not putting you guys on the spot here, but I'm just wondering, has the Fed talked about the order of operations for QT versus rate cuts? Can rate cuts happen while QT is also happening?
Yeah, so that's the plan. They're not changing their QT plan, and so they don't actually sell it. They just they don't reinvest it.
Yeah.
So we know it. It's public information, so you can see how much rolls off every month. And it actually, because so much what they bought was short dated treasuries, it rolls off a lot quicker than I think people realize.
Interesting. So there is a little bit of counterbalance, right? Mm-hmm. If they do
exactly
move forward with rate cuts. One of the other things that I think is hopeful is that the soft landing so far has been driven by the consumer. We continue to see strong retail sales numbers, strong consumer spending. We continue to see a strong job market, and all of that seems to be supporting wage growth. So this idea that we'd be back in a sort of wage price spiral, those two things seem to be disconnected, that we can have prices coming down even while wage growth still remains. Yeah,
the Atlanta Fed wage checker came out yesterday, and it's staying steady in that 5.5% range. The interesting one was, if you keep your job, you're still getting paid a little more, but it's the people that leave their job, and you usually leave a job for a higher paying job, not a lower paying job. But those people are still it went from 5.6 to 5.8. But, in the midst of all the disruption, you could leave your job and get paid a lot more. So those are that metric is kind of leveling off to kind of sustainable levels for a business.
Oh, interesting. So maybe during the Great Resignation, people took jobs.
You could name your price.
You could name your price, and now you're getting more of a steady step increase.
Yep, exactly.
Interesting. So the Fed, again, putting out the vibes of rate cuts for 2024. What are we seeing internationally? There were also some major decisions by central banks around the world.
Yeah, three members of the Bank of England board voted to hike rates again. It was a 6-3 decision, and this is and they were very pointed, in the commentary about sticking with this kind of higher for longer. Now, they've got a bigger inflation problem than we have, perhaps. I think it's fair to say. But, the European Central Bank, which has way worse growth, we can talk a little bit about that. But, the European Central Bank came out and was, pretty staunch in their on hold kind of higher for longer formulation, and considerably more hawkish, I think, than the Fed. Do you agree with Brendan?
100%. And the BOE wasn't a huge surprise, but I think the market was a little surprised by the kind of the hawkish and we're not doing anything tone by the ECB. And that very much showed up in the euro rates because the dollar was weakening on its own. And then you had a kind of a hawkish commentary, both from the board, but then Lagarde's press conference afterwards. She said, we're staying steady. So the euro's strengthened a lot in this week.
And this is with EU, so purchasing managers indexes for December, and they look absolutely awful. They are so weak, and they're in deep contractionary territory, very disappointing in the EU. And that's services and manufacturing. Yeah. It really is a much grimmer economic situation over there, and yet the European Central Bank is holding tight. It's definitely some dissonance here in the messaging, and that really leads us to when we look at the problem with very lofty expectations is they're relatively easy to to disappoint, right? And now looking at Fed fund futures, the markets are now so far into the rate cut into the rate cut expectations that it's I'm looking at it right now. So it's over 70% odds priced in of at least one rate cut by March, and that's not that far in the future. So the potential for this overshooting, and now we've seen it. October was a big overshooting in the hawkish direction. We've seen November and December a big reaction in the dovish direction, and there's a potential, and obviously New York Fed President Williams sort of teased this, that they're gonna it's the momentum's going to go in the other direction, and so there's a disappointment of if rate cuts don't materialize in the first quarter. Is the market going to throw a little tantrum? And also, if we get some sort of if inflation stops improving and just holds steady, that's going to be a major issue for for the Fed. They don't want an echo of inflation coming through. So this is what volatility is made of, these overreactions in different directions. And so our expectation is that Williams is probably kind of this leading this rhetorical, not thunderous, but some sort of rhetorical pushback on the markets. But I just don't think that the markets are really going to listen.
Yeah. And another thing that I think played a big surprise in people's forecast for 2023 was the oil market. And so the data came out today, and OPEC Plus now only controls 51% of the market. And the U.S. production is all-time highs. I think that's also played a role in why the U.S. economy is doing a lot better than the European economy. I bought gas the other day for below $3 a gallon. We were up to $5 a few months ago. So that is, I think, also a large wild card going into 2024. Like John said, that can be obviously higher gas prices drives up inflation. But so far it seems like OPEC cuts really don't have the effect on the oil market like they used to. So there is reason to be optimistic that we could, stay in the $70 to $75 range for WTI and probably 75 to 80 for crude. For Brent.
Brendan, I want to know what gas station you go to, because that sounds like a really good price.
No, my kids do travel sports, so I was way up in North Bethesda.
Okay, got it. That might be a little too far. I'm going to waste more gas than I would save by driving up there.
The wilderness of North Bethesda.
It's hard times out there, Brendan.
It is a weird place.
But another question I had was around how, if the Fed does end up cutting rates, what that does for the housing market, and whether that could actually, whether that would make the supply issues worse.
Yeah. So the last 2 weeks, we've already seen it. So the rates had started to come down even before the Fed cut. But now that the Fed cut, mortgage rates have even fallen faster. So now the average year on a yield on a 30 is below 7%. But the MBA data and the Redfin data, which is kind of weekly, we've kind of had record both new applications and refinancing. That helps people move, but now what we need is more people building. But obviously the building has slowed down too, because it's very expensive for builders to build. But that could help. Actually, this week, one of the best performing stocks groups was the home builders.
Oh, interesting.
So there's certainly optimism on Wall Street that that the housing market could go out for a boom. But there are a lot of weird imbalances in our housing market that are going to take a while to work through, because we just literally need to build more houses.
Yeah, but that's going to take another year, 2 years more to really come through. And so I was thinking about, the macro economy as being in that sort of Goldilocks scenario, the soft landing. But for the housing market, it could be almost a perfect storm, because you have interest rates or mortgage rates falling enough so that people who have maybe been on the sidelines are suddenly finding it to be affordable,
Exactly.
but not low enough so that all those folks with a 3% interest rate are going
Will
to
sell
still
their
give it
houses,
up, right?
yeah.
And we may never see 3% again.
And certainly not in the next, 5 years or at least 3 years, where that's what the housing market needs, is a huge turnover in people, existing homeowners to buy up. But a 2-3% 30-year mortgage is a hard one to give up.
Right, and if we do get that, because it's then not because the Fed is eased off the brakes, it's because we
We'll
probably
be in a
hit a
recession.
financial crisis,
Exactly.
or there's
Yeah.
another pandemic or something
Yeah.
that a consequence or a driving factor that we don't want to see.
Yeah, the Fed is looking to normalize rates, not go back to where we were.
Right, but where is normal? I mean, what
They've
what
kind
is
of
the market?
admitted they don't know.
Well, this has been a problem throughout. For
that's
couple
not a new
years.
one. It's been for probably about 20 years. Yeah.
Yeah, the long-term dot is 2.5%, but there are some long-term dots that are way different than that. A couple lower, and then a few that are like in the mid threes, and it's a pretty wide distribution, and and the Fed has been pretty vocal that they don't really know where the neutral rate is, or where the long-term rate is. It's what I think is the idea that monetary policymakers don't want to go back to a zero lower bound, like in any way, shape, or form. It's a very uncomfortable place for them. They spent a long time there post global financial crisis. It was hard to get out of. It didn't do what it was supposed to do in terms of the economy. We had, remember, the secular stagnation years with very, very low interest rates. It creates this, if you're trying to ease from zero, you have to do all these, monetary magicianship things, which we're seeing them trying to unwind. I think they're trying to close the book on that, that zero interest rate, QE, monetary extremes era.
Especially QE. I think they've realized that one doesn't really have the huge effect that it does. And also it becomes a political issue because you hand the money back to the Treasury, which goes to the White House. So I think they're very happy to return the balance sheet back to where it was global financial crisis.
Yeah, the last negative interest rate stalwart. Is it the last one? Bank of Japan still hanging tough.
They have a meeting next week.
Negative interest rates, and it really we've seen a lot of crosstalk, right? And the traders are leaning into the Bank of Japan normalizing interest rates next year, like with the Fed cutting rates supposedly 150 basis points, and the Bank of Japan hiking rates, not like 100 basis points, but even like 10, 20, 30 is a big, huge move for the Bank of Japan based on where they are. And there's a ton of intrigue about it. And the Bank of Japan has been giving people whiplash with communications one way or the other. So, it remains to be seen, but they've certainly got the inflation is above their trend, and so to normalize to at least zero or some sort of positive interest rate, even the Bank of Japan has that opening.
Do you think that the U.S. The Fed is sort of the first to go in terms of signaling the potential for rate cuts, or is the Fed going to sort of release the dam, if you will, and other central banks will follow suit, or what might it do?
Or are they forced to follow? Yeah,
right. What might it do if the Fed's the sole mover? We've got Bank of Japan, we've got ECB still on hold. Are they going to be forced to act?
Yeah, just with the exchange rate moves could be strong enough that maybe not the ECB and the BOE, but certainly the yen would have outside moves in that scenario.
But it's coming from such a weak. The yen is so weak that it's got to
lows.
Appreciate. It's going to be a long move before they start to.
It
really starts to cause them pain.
Yeah.
But again, it's the speed of it, and the likelihood is that. The great likelihood is that dollar weakness that we're seeing here is probably overshooting. And, if the Fed begins to signal, even if they begin to signal, hey, we don't think we're going to cut rates in the first quarter, that's tightening from where we are right now. So, that's the kind of counter reaction that we're likely to see early next year.
Well, I don't know if anything else can happen in the coming week that could overshadow the big week of economic news that we've seen over the past couple of days. But anything on your radar for next week, guys?
So we get the Fed's preferred price measurement, the PCE price index, and with that you get personal income and spending, and then the Bank of Japan. Those are kind of the two big events of next week, and then I think a lot of the world is on vacation, right?
Yeah, if the Bank of Japan does anything, it'll be a surprise. The last signal that they had was we're not in any sort of hurry whatsoever. So, hopefully it's a quiet week. Everybody shifts into holiday mode. Everybody's bullish on everything, including eggnog, and we can just drift pleasantly into year end.
Eggnog futures are spiking right now. John. Well, that does it for us today, everyone. I'm Ylan Mui with Penta. My co-hosts are Brendan and John of Markets Policy Partners. We hope that you enjoyed our show. And remember, you can always listen, like, and subscribe to the Macrocast wherever you get your podcast. Thanks for listening.